So when it comes to the sale of your farm operation, there's a lot of emotions that farm families go through, and that's no different when it comes to your farm auction itself and the sale of that machinery and equipment. And while, auction sales nowadays are more virtual and not so much of a community event anymore, there is a lot of anticipation and excitement in watching and seeing what those prices go for in the auction sale. Now, we all know the cost of new machine and equipment, it is through the roof. And that has provided, secondary markets or resale markets of used equipment to be quite strong. And so quite often you're surprised by what you get in the auction sale proceeds amount. At the same time, you kind of get surprised perhaps by the amount of taxable income that is generated through recapture on depreciation. And perhaps it's that surprise a little bit that gets people thinking, well, that's kind of an unfair or unjust tax. Well, as we walk through that, there's really nothing unfair or unjust about it, which I know doesn't make you feel any better. However, the key is it's a form of taxable income that can be managed. And that is where working with a professional advisor and financial planner who can provide that forward looking tax planning can ensure more of those potential tax dollars stay in your pocket versus Revenue Canada. Hi, my name is Ryan, one of the financial planners and advisors here at Pellegrini Financial in Red Deer, Alberta. So first off, what is depreciation? Well, depreciation is a loss of value in an asset. And I think everyone's kind of familiar with the old tale of, you go down to your own local auto dealership, you buy that new pickup truck, and as soon as you drive it off the lot, it's worth less money. It's used. And the reality is, if understanding depreciation or the loss of value on any particular asset, well, it's really hard to determine. If you looked at your farm operation, well, truly the only way to evaluate it is say, buy that tractor at the start of the year. Go through your farm season, sell it at the end of the year for presumably a few less dollars. And the difference between those two numbers is the amount of actual depreciation or expense that you could then claim for tax purposes. Well, I think we all know that's not very practical. Even the government understands that's not very practical. And so they created a process known as undepreciated capital cost allowance. It might be more familiar to you as undepreciated capital cost pools or UCC pools. And the common ones in farming are UCC pools class 10, which is motorized equipment. And you depreciate those assets at a 30% rate. There's UCC Pool Class 8, which is non-motorized equipment, and you depreciate that at 20%. And then UCC Pool Class 6, which is buildings, and you depreciate that at a 10% rate. Now, how do these pools work? Well, these pools, I guess the first thing I really want you to understand is these tables exist in your tax return. Number of rows, number of columns, and the ending value in each of those pools has a meaning, obviously. And that meaning for that ending value is what I want you to think of as basically your purchase price or your depreciated cost value on that particular asset. And obviously within the pool, it's an aggregation of all of those pool's assets. So it's a tax paid capital amount. So when we look at the pool balances, as you could expect, the ending value of 1 year becomes the beginning value of the next year. And so let's walk through an example of class 10. And so we're going to assume that there's no ins and outs through the course of the year. At the end of the day, it's a status quo pool. And so, okay, we ended last year with $1 million value in that balance. We start the year with $1 million value balance. And as we go through our farm year, we're going to depreciate those assets. And we get to the tax filing stage, we're going to take 30% of that $1 million value and use it as a depreciation cost or depreciation expense. That expense is what you're offsetting against farm revenue, whether that's grain sales, cattle sales, milk production, whatever your operation is. You're going to use that expense to bring down your farm taxable income to a reasonable amount. Now, coming back to the tables, so that 30% amount is on $1 million, $300,000 of an expense. And so we start with $1 million, we've deducted $300,000, and we end up with a $700,000 pool balance now in class 10. Now let's assume that is the end of our farming. And so next spring we do have an auction sale. And so specific to those class 10 assets, auction proceeds bring in 1.2 million. So what happened there exactly? Okay, we got 1.2 million of auction proceeds, a $700,000 cost base. There's a big differential there. Well, ultimately, we claimed too much in expenses. We actually made a mistake in our tax filings. Maybe not just in the previous year, but an aggregate of a few years. Now, for the average taxpayer, what happens when CRA notifies you that you made a mistake? Well, first off, they want you to pay that tax bill like ASAP. What else do they do? Well, guaranteed you're going to have some interest charges and or penalties. Now, in this situation, they look at that and say, you know what, you followed our process, you followed our tables. So you know what? There's no interest, there's no penalty. All we ask you to do is bring that back into income. So recapturing that excess depreciation expense you claimed and pay tax on it. So the 1.2 million sale value less your $700,000 cost base is $500,000 of taxable income they're asking you to bring back into your tax return. So in the end, this is really a reconciliation process of what the assets are truly worth versus what you depreciated them to. So is it unfair or unjust? Well, no, not really. But again, back to the top of the video, the key part of this is it's a form of taxable income that can be managed. Now, in farming, I understand that income management is fairly easy in the concept of when you're actively farming, you can defer income, you can re-expense income in different ways. And so managing income is a little easier. When it gets to retirement, well, that gets a bit more challenging. Now, there are different processes and pools or tools available for anyone to manage their income. And one of those I think that are maybe not as used as often as they could be is something called a class amalgamation. I think we all know examples where mom and dad have sold the farm, but of course have no intention of leaving the farm. So maybe they sold everything off other than the home quarter. Or maybe they carved out their yard site into an acreage and sold the rest off, but they're staying on the farm. The key to that is that they're not selling the buildings, right? They might have a shop or two, they might have a barn, a number of granary bins, and so on, and they haven't sold those assets and they're not intending to, nor do they even need to depreciate them anymore. And so class amalgamation is something that the tax rules allow you to take a series of pools, and this could be your class 10, 8, 6, and whatever else you might have, and bring them all together into a separate pool on their own. What's the value of that? Well, in this instance, so we had 500,000 of taxable income in our class 10 pool. And so class 6, we aren't selling any of those assets. But let's assume that that ending balance in the previous tax year was $100,000. So tax cost base, tax paid capital amount. Well, that $100,000 is something now that you can actually use to offset some of that income from the class 6 pool sales. So your 500,000 of taxable income can turn down to 400,000 of taxable income. We've reduced your taxable income by 20% by a simple accounting procedure. And so examples like that are phenomenal to use with the rules that already exist. And that is where working with a financial planner and advisor who can provide that forward-looking tax planning can ensure that those potential tax dollars stay in your pocket versus Revenue Canada. We hope you enjoyed this video. Like, subscribe, and follow us for more ag tax videos from Pellegrini Financial.